Hello, my name's Kane Hooper and I'm the owner of Cloud Accounting Partners. I've started this particular series of videos to give business owners the fundamentals of accounting. Accounting is quite an important subject because it gives you the information about the finances of your business, which is ultimately why you're doing it, is in order to get finance, make profit, get money. So that element of accounting is such a vital part, yet is made to seem so complicated by the accounting profession. I wanted to do this series because I was so sick to death of accountants and their pompous manner of trying to make something that is extraordinarily simple, extraordinarily complicated. Personally, I've run 8 businesses and I've done quite well and studied an MBA specializing in accounting, graduated top of the class. The reason I wanted to study accounting was prior to that point, I had to rely on accountants in order to tell me what was going on in my business. I figured it was time I learnt myself. So this is what we're going to cover. Part 1, which should go for about 6 or 7 minutes, is going to cover your financial position, where you sit financially in your business, and this is going to cover the balance sheet, which is a vital part. All right, so I'm going to start with something very simple, a house, in order to explain this particular concept. So the house itself is considered an asset, and in this case, let's say the asset is worth $500,000. Now, what we want to know when we're looking at the house is how much is owed to the bank. So in this case here, we're going to say about $200,000 is owed to the bank. And that's considered a liability because you're liable to pay it and it's an obligation to the bank. So in effect, in this case, of the $500,000, the bank owns, until you pay it back, $200,000 of it. The remainder here, this top portion of $300,000, is what you own, and this is what's known as your equity. So when you own a house, you're very interested in how much equity you have in the house, and that's in effect how much you personally own. If you sold it today, how much would you get? And in this case, if you sold it today, you pay the bank back $200,000, you get $300,000. So we can look at it another way. So this $500,000 house is equal to the $200,000 owed to the bank plus the $300,000 of your equity. Or in another way, the asset is equivalent to the liability owed plus the equity. And this is the fundamental element of accounting, and it's known as the accounting equation. Very simple, right? Your asset, any asset you have, is either owned by you, equity, or in some respect is owned by others, the liability. And that's what we want to look at with your business, is how much of your business do you actually own? So let's take, for example, this shop here, a bakery, and it's owned by Tom and Jane. And they've been running for a few years and been doing very well. We'd like to know if Tom and Jane decide to sell their business today, what they would actually get for that particular business. So the first thing we need to look at is, well, what is the total business worth? Its asset. And let's just say it's $2 million. But unlike a house, it's made up of many different elements. How much cash the business has, the inventory the business has to run it, accounts receivable, so money owed to you by customers, the equipment you have to run the business, any vehicles you use in the operation of the business, and possibly, if you own it, the building itself. So all these elements in this case add up to $2 million in assets. So now we want to look at the liabilities of the business. What does the business owe to other people? And in this example, it's $1.5 million. And that could be made up of credit cards, bills owed for supplies, any leases on equipment or vehicles, and major loans to the bank. So in this case, Tom and Jane owe $1.5 million. And therefore, we need to look at how much equity Tom and Jane actually have. In this case, it's $500,000. So here we go. Tom and Jane, if they were to sell the business today, would make $500,000. And this business, this asset, this is what it is worth to them in the current market. And this is what accounting tells us. So we can look at it again this way. The asset of $2 million is equal to the liability of $1.5 million. That's what owed to other people, plus their personal equity of $500,000. And this is what we look at when we're looking at a balance sheet. That's all it is. That's what the balance sheet shows you. It shows you on one side, well, what are the assets? We've got cash, inventory, vehicles, equipment, and the total value of the assets is $2 million. So on the balance sheet, we want to then look at, well, okay, good. If that's the total value of the business, how much is owed to other people in the form of liabilities? So you've got bills, we've got credit cards, leases, and bank loans. And in total, that comes to $1.5 million in liability. So now we can show, if you went assets and you took away the $1.5 million, we're obviously going to have what's left over in equity, which is what Jane and Tom own, I should say. So they have shares in the business, so their equity is made up of shares, the amount of money that they put in the business to start with, but it's also made up of their profit, because every year when they make a profit, their cash is going to go up, so therefore their equity, or how much they own of the business, is going to go up. In this case, they own $500,000. And this is what the balance sheet in effect is showing you. It's showing you all the assets, which is worth $2 million, broke that down into all the liabilities owned, which is $1.5 million. Therefore, what we have left over, either made up of shares or profits, is $500,000. So this investment for the two owners is worth $500,000 to them personally if they sold the business today. And that is all you need to know at the front end of a balance sheet. And we can go into more detail and analyze the balance sheet, which we'll do another time. But the next thing we want to look at in the next video is the profit and loss report. Because the equity, how much of the business you personally own, is very much affected by how much profit or your loss you make each year. But in terms of the balance sheet, that is it. So as I said, next week, part 2 will be the financial performance of your business, your profit and loss. And my business, Cloud Accounting Partners, specializes in online bookkeeping and accounting. And what I'm really, really excited about is the virtual CFO program. Because I'm sick of accountants. I'm sick of them just giving information for tax purposes. I want to give business owners information that they can use on a week-to-week basis to run their businesses. Not profit at the end of the year. How about profit every week? Anyhow, I'm very passionate about this area. And thanks so much for watching. And part 2 should be out very soon.